we mentioned currently at Variant Fund, where we're investing in Web3, and that is crypto. And I guess first question is, how do we define Web3? And this, I think, our definition of it is a term Lee mentioned, which was also inspired by our collaborations in the past. Lee is best known for the passion economy, and Variant, I think, is best known for what I call the ownership economy, and that's how I define Web3. And so the ownership economy thesis is that crypto networks have unlocked a new economic model for networks that are built, operated, and owned by their users. And I think this is a lens through which you can look at the success of Bitcoin and Ethereum and other emerging networks that have grown really, really quickly. Bitcoin and Ethereum, I think, are the first examples of multi-billion-dollar networks where there is no company. There's just a group of independent participants all over the world who collaborated to build the software, run and operate the software, and their incentive for doing so has been an ownership stake in the network itself. And that, of course, is the mining rewards for Bitcoin and Ethereum miners that operate those respective networks. And what this visual is showing here is sort of an evolution along the y-axis. We're moving from institutionally owned and operated networks to user owned and operated networks. Of course, store of value, that's evolving from the Fed to Bitcoin, and with infrastructure, something like AWS is being realized in a completely user owned and operated way with Ethereum and Arweave, which are both developer facing crypto networks. But what's happening over time is we're increasingly moving along this x-axis from developer-facing networks to consumer-facing networks. And in that evolution, there's a lot of stuff that I think will come to touch the creator economy. But the core idea here is that ownership is a really powerful incentive to get users to contribute to the products and services that they interact with every day in a more meaningful way. And very often that that incentive accelerates or can accelerate the network effects of these platforms, resulting in networks that grow much faster and hopefully much bigger than their institutionally owned counterparts. And just to give one concrete example of that, I always like to throw up the example of Uniswap, which is not directly a creator facing product, but may play a role, and we'll come back to that later. But Uniswap is an exchange for crypto. So the right mental model is to think about it in the same way you think about Coinbase, in that both are venues to trade crypto tokens. Coinbase has been around for 10 years, and they have over 5,000 employees, and it's a very successful, very valuable company. They do about $1 billion in trading volume every day. And meanwhile, Uniswap has been around for 2.5 years. It's a team of less than 20 people, and they are doing about $1 billion a day. So 50% of the volume of Coinbase, which just gives you, I think, a really clear indicator of how much leverage ownership over the networks and products that people are using gives founders of these projects to grow network effects quickly. So that's the ownership economy thesis. That's how I define Web3. And there's a lot of stuff happening at the intersection of the ownership economy and the creator economy. And so here's a brief outline of what's working in Web3 for creators today. So I would assume everyone on the call has heard of NFTs, at least, if not done a deep dive already. I know Lee is, the latest success story in as far as NFT creators go. But so we'll talk about NFTs. We'll talk about the concept of Patronage Plus, which is multi-dimensional, but in short can be described as a new model for crowdfunding. We'll talk about social tokens, and we'll talk about DAOs and investment clubs. So let's talk about NFTs. So I'm assuming people know about them, but I'm going to give a very quick definition of NFTs. And I wrote a blog post about them, and one of N,000 thought pieces on it. But I think the simplest way to think about NFTs is as a new kind of file format for a file that lives on the blockchain. And this is important because it sort of has the potential to really change the way that media propagates online. If you think about the way, the relationship creators have with platforms where they distribute their work, you need to sort of think about it, or the way I think about it is you go to a really fundamental level and try to look at the transaction that happens when a creator posts to a platform. Two things that I think are really important happen. One is the creator is uploading a file from their computer to the server of the platform that they're distributing on. And very often they're also copy pasting ownership of that file to the platform. And I'm talking specifically about social media, not less so about passion economy platforms. And what I mean by copy pasting ownership is that somewhere in the terms of service, when you sign up, a creator is sort of consenting that the platform can take that file and copy it and use it however they see fit, monetize it however they see fit. And what's very different about NFTs is rather than copy pasting a file to someone else's computer and copy pasting ownership, by uploading a file to the blockchain, you're making that file ownable in the same way you can own a digital financial asset or a digital currency asset like Bitcoin. And that is verifiably yours without any dependency on a third party. So there's a critical difference here, which is when you distribute media via platform, the platform takes ownership and they bundle monetization with distribution. When you upload a file to the blockchain, you have ownership as the creator, verifiably so, and independent of any third-party platforms. Right, so I already said this, but just to hammer it home, NFTs make it possible to own digital media assets in the same way that you can own a digital currency asset like Bitcoin. And I think this can lead to a world where NFTs become the quote unquote port of entry for all pieces of media on the internet. The reason being that all the participants involved in the media ecosystem stand to make more money. And again, money is a very powerful incentive to drive new standards. So how can everyone make more money? Well, creators can make more money because if they own their work directly and can monetize it with their audience without depending on a third-party platform, more of the value can flow directly to them. And furthermore, collectors, people who are buying their work, can also make more money through a system of true digital ownership. So rather than renting access to a creator, as you do on lots of Web2 platforms, you can now invest in a creator, and investment comes with the possibility of future returns. So if you invest early and the creator's work increases in value, you can make money from that. So that's a very powerful incentive for creators or collectors rather, to get involved. And that's what's been driving the frenzy in NFTs to date. And then finally, developers can make more money by building for these other two participants, because developers have few options to build on top of Web2 platforms. And if they start to make money by building on top of Facebook or TikTok or whatever, it's very likely those platforms will shut them down or start to compete with them. Whereas with NFTs, you're building on top of open permissionless infrastructure, just like Bitcoin. No one can shut off Bitcoin, no one can shut off Ethereum, and no one can shut off your NFTs on those networks. And so developers have the opportunity to step into this growing market economy, which is completely permissionless. And so there'll be a lot of innovation to serve both creators and their collectors and audiences. And that's why I think every piece of media will eventually become, or enter its life on the internet as an NFT. It gives all these participants an option on the future value of that work without having to confer or give some of the value away to a third-party platform. What's working in NFTs right now? There's, first off, a lot of different types of visual work that are being sold. There's open edition drop culture, right? So Nifty Gateway and NBA Top Shots are both, in different categories. Nifty Gateway is more skewed towards art. NBA Top Shots are collectibles, like basketball cards that are digital, and they're both selling series of works or edition works, right? So it's not one of one. You're buying a piece of a series or a piece of a collection, and that's working really well because it allows the issuers to capture more of the demand under the demand curve. And I'll come back to that concept in a moment. But this, the open edition drop culture is a really successful sort of format for releasing NFTs. Then there's these hyper exclusive collectibles like CryptoPunks and Unisocks, which are CryptoPunks you may have heard of. It's generative artwork, these sort of like 8-bit emoji icons of people, and these were created in 2017 by sort of a small developer studio, and they've gone on to become these hyper sought after collectibles. All of them live on the Ethereum blockchain. Dylan Field, the founder of Figma, sold one that he collected for $7.5 million earlier this week. And what's really cool is there's this whole community emerging around CryptoPunks. The owners of these punks are forming discords and Telegram groups, and there's all kinds of utility being built on top of owning a punk. So, I've heard from a number of folks who are deep into collecting CryptoPunks. It's not just about owning the thing and potentially making money reselling it, but being part of this community of other collectors who are also excited by them. There's Crypto Kitties, which are another sort of early collectible series similar to CryptoPunks. Unisocks is a little bit interesting in that this is a project from the Uniswap teams that I talked about earlier, the decentralized exchange. They made these really cool designer socks, limited edition, and they tokenized them. And you can redeem your token for a physical pair of socks, or you can just trade the token on a market and speculate on the future demand for it. And I think they're now trading at 6 figures. So probably the most expensive socks ever. And there's also digital art. And sorry, the bullets here are repetitious, but I meant to change that. Digital art and memes are selling, these tend to be one-of-one works. So Nyan Cat over here on the right sold for close to $600,000 in ETH on Foundation. Bad Luck Brian, other popular memes are selling. So it's now possible to own a piece of internet history, and NFTs are the way to do it. And then there's also just, not meme art, but all kinds of, visual work and other formats of artwork selling on marketplaces like Foundations or Super Rare and others. And Beeple is one artist who sort of got his start on these marketplaces and then just recently sold an NFT for $69 million, which apparently I think is he makes him the 4th highest grossing living artist ever. So needless to say, a lot of money and, flashy numbers. Of course, that's an indicator that we're in the midst of a hype cycle around a disruptive new technology. And I think it's very easy for folks to, get kind of turned off by that and say, this is just a hype cycle or a hype that can't last. But I think, as I described earlier, I think the disruptive technology here is really powerful and will continue to become a more and more important role of products we interact with every day. So even if the market does correct and the value of that these assets are selling for does come down, I don't think the technology is going anywhere. So that's some of the stuff that's working right now, sort of headline news and NFTs. And then there's a lot more sort of fringe stuff at the periphery that I'll get into. So I just wanted to touch on, monetization strategies for some of the NFTs or NFT markets that are working right now. And we got into this a little bit when I touched on open editions. This is a chart from Chris Dixon's blog post on NFTs, wherein he goes over the all important idea of maximizing the full area under the demand curve for a creator's work. And essentially what he's showing here is that the worst way to capture demand for creators' work is to put it under an ad-based model, because there, your work is sort of getting grouped in with all the other stuff on a platform who's monetizing in a sort of one-size-fits-all ad-based model, and you're getting very little of that revenue captured. Better than that is what he calls cream skimming, which is, setting a price for your work and putting it behind a paywall. He also bundles a single NFT in here. So selling a one-of-one allows one person to pay you X amount of dollars at a given price for your work. And it's similar to saying the price for my, Substack is $10. Well, that might be the right price for most people, but what about your super fan who's willing to pay $100? Or what about your sort of curious fan who's not quite there yet, but would be willing to pay $1? How do you meet them? So the best is tiered pricing. And that's where you have different sort of, tiers for products that you offer. The really common example or familiar one is Kickstarter, right? You can back a project with $1 and get X, $5 and get Y, and $100 and get A, B, and C. And that's what open editions enable in the NFT market. So, with Nifty Gateway, you're seeing drops like, Grimes, I think, sold 6 million worth of NFTs. Some of them were, high priced very rare editions, and others were more like posters, right? Sold for $10, and that enabled her to capture the full area under the demand curve. So this is a really important idea that I think is currently, being employed by a few NFT marketplaces, but really underappreciated. The fact is NFTs are programmable. They're zero marginal cost to create. And so the opportunities for creators to get creative in how they monetize this sort of new asset that they're able to put to market. So this is different monetization strategies. This is a chart prepared by Cooper, who is an advisor to Variant Fund, and just goes over sort of a landscape of different places to issue assets. So sorry, let me just move the zoom out of the way. So there's tons of different marketplaces and places for creators to issue work. So I'll go through a few of the boxes. There's curated marketplaces where you sort of have to get permission to be on them. Super Rare Foundation, Nifty Gateway, they all have, an invite system at best, and at worst, you have to like email and talk to somebody there to get on the platform. And curation is valuable in that, like the traditional art world, it helps people suss out what's worth paying attention to. But the downside, of course, is it's not open to everyone. And so there are permissionless marketplaces like Rarible, OpenSea, Mintable, where anyone can mint an NFT. Benefit of that is, the tooling is accessible. The downside is if you mint on that platform, odds are nobody's going to see or pay attention to what you create. But there's sort of a synapse between curated marketplaces and permissionless ones. And that's because NFTs, again, they don't live on the platform, they live on the blockchain. And so when you mint an NFT on OpenSea or on Rarible, it's in your wallet and you can bring it with you anywhere. You can bring it to any of these other marketplaces. You can definitely bring an NFT from OpenSea to Rarible and vice versa. And if you later get onto Foundation, they can see an NFT that you minted on another platform. And at some point, I imagine they will support the ability for you to showcase your work from elsewhere on their curated gallery as well. So that raises some interesting questions if there are folks thinking about, starting a project in this space. It raises the question of, multi-tenanting. There's creators have work on all of these platforms. Where does the defensibility lie? And I think that's a really interesting question that we can explore in more detail later on. But yeah, that's sort of an interesting synapse between curated and permissionless marketplaces. There's also Zora, which I think sits in a slightly different category in that they're more developer facing. Right way to think about them is tools for any developer to build an NFT marketplace like Super Rare, like Foundation, build your own sort of gallery where you can mint work as a creator or as a curator and sell it. So that's sort of an open protocol that developers can, compose into new experiences around NFTs. Let's see, what else is worth discussing? Right, digital fashion. So I think digital fashion collectibles are both sort of adjacent to the art marketplace. Digital Axe is really worth checking out. There's some amazing fashion designers creating purely digital work and people collecting it, for the same reason they're collecting digital art. But you can very easily imagine these digital fashion assets making their way into third-party distribution platforms like virtual worlds, gaming, or even just social, like through lenses and the like. So that's a really interesting and kind of underexplored category, but where there is early traction in NFT sales today. There's tons of collectibles, which we talked about, like CryptoPunks and so on. And then one really interesting emerging category is generative or programmable artwork. So this is artwork that's sort of medium specific. It takes advantage of the programmability of Ethereum. Artblocks is a really cool marketplace where creators are writing scripts that programmatically generate visual work based on input from the blockchain. So like, for example, based on the random sort of activity in a given block on the Ethereum blockchain, an art block's work may dynamically respond to that input and generate a new output. And so there's this whole kind of new genre emerging of medium specific or smart contract specific generative or programmable art, which is pretty cool. So this is only like a small fraction. This is about, I don't know, a month or two old, and this is just a small fraction of all the stuff happening in this space. There's lots more not pictured here, but just to give a sense of all the activity. So, okay, so where are NFTs heading? And I've kind of touched on this a little bit here and there in the conversation thus far. So there's a popular concept in DeFi, which is, decentralized finance, that what's really happening in Web3 is we're building a system of money Legos. And that, what I mean by that is, all of the activity in the DeFi space, like Uniswap, like Compound, are these open marketplaces that run on blockchains like Ethereum. And again, what that means is, no one can shut them off. And because no one can shut them off, they become these building blocks that developers are very confident about building on top of. And when developers build on top of the work that other people do, they can build more with less. And so what we're seeing in DeFi is this very, quickly erected ecosystem of money Legos, where people are composing all of the different sort of money marketplaces into new experiences for consumers. And I think the same exact idea is going to play out in NFTs, where with all these marketplaces, all these new types of work coming onto the blockchain, what we're effectively building is a universal media library where all the world's media is open and programmable to developers. And, again, contrast that to the way social media works today, where only Twitter can control what we see in our feed, or Facebook and Instagram in the same way. If we have an open library of permissionlessly programmable content on the blockchain, we're going to see a lot more innovation, a lot more competition for how we consume media online. And that's why I say NFTs enable this ecosystem of media Legos, where any developer can build, new experiences for creators and owners of their work, to experience that media on the internet. So that's another way of saying that, or coming at it, is right now we're in the speculative phase where markets are driving the adoption of NFTs, but very soon we're going to move to a more utilitarian phase where developers are building new experiences around the assets that we are creating and owning on the internet. Okay, so I was going to switch gears and get into Patronage Plus, and this is, Lee, this is going to come back to some of the ideas you were talking about with James last night on Clubhouse, the fractionalization of NFTs. So first, I'll start off by defining Patronage Plus. So okay, so everyone here is probably very familiar with with the idea of patronage. Platforms like Patreon and Substack allow you to become a patron of a creator whose work you admire, and support them financially. Patronage, the plus part of Patronage Plus is the possibility of being able to profit from your support of a creator. And I said this line earlier, why subscribe when you can invest, right? It's sort of like, why rent when you can own, right? And we're starting to see a lot more platforms emerge that give both creators and their audiences more flexibility in how to enable this Patronage Plus ownership crowdfunding model. So NFTs, I think, are just the tip of the iceberg, right? NFTs have been instructive or formative for folks in understanding the idea of true digital ownership, but you're starting to see people experiment with how those NFTs get created, bought, and sold. And one of the most interesting experiments going is on a platform called Mirror. Mirror is a decentralized blogging platform. At least that's what it looks like at the surface. And what that means is it looks very much like Medium, better design, but all the infrastructure is completely decentralized on top of blockchains like Ethereum and Arweave. But that's not the important part. The important part is every blog on Mirror is or will be soon minted as an NFT. And what that enables is for people to actually own the ideas that folks are publishing on the platform. So on the right here, this is the very first experiment on Mirror, was a crowdfund for John Palmer, who's an author, to write long form sort of investigative piece or thesis on a specific topic. And so what John did is said, hey, here's this topic that's going to take me a while to think through and explore. If you want to see it, pay me. And in that sense, not very different from Substack, but The key difference is that when backers came in to support him in this endeavor, what they were actually getting was a share of the NFT that would be minted when he published the essay. And so that's, you know, an example of taking an NFT, fractionalizing ownership of that NFT to your supporters who back your project, which, you know, gives them the patronage that we're accustomed to in Web 2, but with the plus of the possibility of profiting from the resale of that work in the future. And you may be wondering, you know, why would someone want to own an essay? What's the point of minting an NFT as an essay? Well, you know, the very base case, I think, is, you know, people want to support interesting ideas. And if an essay goes on to be, you know, win a Nobel Prize for being such an amazing idea, you can imagine just wanting to be on the list of early supporters who back that thing. And I think that's sort of the base case. But you could take this idea pretty far. So, you know, on the other end of other extreme, imagine Elon Musk publishes the secret master plan for his next company, you know, like he did for Tesla early on, and he mints that as an NFT. He could then sell that NFT as a way of financing that company. So if you think about, you know, you guys probably heard Jack minted his first tweet as an NFT and sold it retroactively for millions of dollars. Well, imagine the next Jack or the next, you know, Twitter founder or mints an NFT of their Hello World blog post and sells that to an audience in order to finance the business. You know, that's what Patronage Plus, I think, enables. It's sort of a new way of giving ownership to your biggest fans, your audience, and potentially a new way of bootstrapping a user base for a new product or service that you describe in that blog post. So this is a really interesting sort of frontier experiment that, you know, right now looks like kind of just a weird way of selling blogs or making money as a long form writer, but has a lot of potential to really monetize all kinds of new creative ideas. And I think, you know, we'll see a lot more Patronage Plus activity in the space soon.
We have a couple of questions.
Okay.
It's pretty simple. Any concerns or issues with SEC restrictions on investing for accrediteds in NFTs?
So NFTs themselves, I think, very, very low risk in terms of, you know, regulatory issues, because I think there's a ton of precedent for, you know, baseball cards not being securities, you know, all kinds of collectibles. Art is not a security when you're buying it directly from the creator. Now, when you get into fractional ownership of an NFT, I think that raises more questions around the, you know, regulatory dimension. For example, if you fractionalize ownership of a Picasso work and, you know, put that in a hedge fund, that is very much a security. And now that said, you know, my view on all of this is that you can't put the genie back in the bottle. And, you know, this technology is here. People are fractionalizing work. It's very easy to do it technically. And so the SEC may not love it, but, you know, at the end of the day, it's a new way for creators to make money. And it's a new way, you know, a new thing consumers want to do. And I think the market, you know, is going to grow very rapidly as a result of everyone having skin in the game to jump in. And if the SEC doesn't like it, they may make it harder for U.S. investors or U.S. users to participate. But the technology is not going anywhere. You know, as long as you have an internet connection, you'll be able to access these markets, and people will find a way. So, you know, I'm wary of it, but I'm also confident that the market will triumph here.
Cool. Cassidy, do you want to go next?
Yeah, sure. Jesse, thanks for doing this. I'm curious about your thoughts on the impact of interoperability what it could have for creators long term, specifically related to IP protections. Like, do you think the norms of copyright and licensing that we see today will hold up in Web3?
Yeah, that's a really good question. So on a long enough time span, I do think that copyright and licensing and sort of traditional IP will all move on chain. It's very, you know, it is the right tool for the job, and in that if you want to administer, you know, royalty flows in a programmatic automated system that's instantaneous, that's exactly what, you know, cryptocurrencies enable. That said, it's important to note that, you know, IP, copyright law, is in the domain of nation states, right? Like the United States has different copyright law than Canada and the UK respectively, right? So there's this whole sort of like nationalistic administration of copyright that just does not map to the internet at all. And so I think it is important to view NFTs as a break from traditional copyright and IP law. It's really a new asset class and a new sort of rights administration system that is entirely independent of nation states, just like Bitcoin is a sovereign currency that is entirely independent of any central bank. And so in the short term, my view is that the NFT ecosystem, being sort of permissionless and interoperable and composable in this sort of media Legos way I described, it's going to move very, very quickly and much faster than the legacy copyright administration world is going to move. So I think, an analog here is like in the early days of the internet, you had, the information superhighway, which was all about, big enterprise moving their processes onto, computer networks. And of course, that all happened in time. Now all enterprise processes run over, on SaaS platforms over HTTP, but it took about 20 years. And in that 20-year period, there was tons of innovation by developers building net new things because they could in a permissionless fashion. So I think it's far more likely that we'll see something akin to, royalty administration, but in a completely Web3 native way. And we're actually already seeing that on some of the web NFT platforms where creators can specify a royalty that they want to get when their work is resold. And that royalty can flow in a completely programmatic way without any third-party administrators. So that's an early example of, Web3 native royalties. And I think there'll be a lot more innovation there well before the legacy copyright ecosystem gets online. So yeah, that was Patronage Plus. I guess one on the left, I didn't talk about this, but this was just 2 nights ago. There's this group of folks, the S1 Club, and they sort of review the S1 filings of companies that are about to go public. They crowdfunded 20 ETH, which is almost $30,000 or even more than that. And they came up with this really kind of complicated, but also very interesting way of distributing those funds to all the participants in their sort of community that contributed to the S1 analysis. So again, sort of an interesting example of long form analysis journalism being funded by a community of incentivized participants to get the best possible work, in the public domain. So pretty cool experiment, and there's going to be lots more of this happening soon. Okay, so moving on, social tokens are this other sort of interesting idea. This is very early. I'd say it's not clear that social tokens have clear product market fit yet, but there's a ton of experimentation going on here. Essentially, social tokens are the idea of a token that's tied to a person or a community. So we've talked about, tokens as a way of conferring ownership value over a platform or service to the users of that product. We've talked about NFTs, which are, tokens for representing a digital file or piece of media on the internet. And now there's, also the concept of tokens as a way of investing in a person. And there's been lots of different experiments here. Personal tokens like Alex coin are, there's basically redeemable for time with the person. So I think actually the best example is Boy. The Boy token is redeemable for 1 hour of time from Datboy, who is the lead designer of Foundation, the NFT marketplace we talked about earlier. And those tokens trade in the market. So if you think his time is really valuable, you can bid it up. And if you're just a passive speculator, you can speculate on the future value of his time by buying those tokens as well. And then yeah, there's been a couple of rappers and musicians who've minted their own cryptocurrency. I think the TLDR here is it's not clear yet what the default interaction model is between a social token issuer, a creator, and their audience. In other words, what do the token holders get? That's to be defined by the creator. And I haven't seen a model that's repeatable in a sort of general way across different types of creators and like large audiences. So there's a lot of sort of, I would say fertile ground to explore here, but the specific product market fit about how consumers should think about owning social tokens and what they get in return for them hasn't been clearly defined. And, I think the opportunity is for founders to build products that offer clear templates that work, opinionated templates that work. Thus far, it's been a lot of sort of independent folks experimenting on a one-off basis with their audiences, but, what's the repeatable model? I think that's the question here. And then let's see, DAOs and investment clubs. So first off, what the hell are DAOs? DAO is sort of Web3 parlance for a community-owned group or investment club. It actually stands for Decentralized Autonomous Organization, which is a mouthful. And Vitalik Buterin, the founder of Ethereum, is, I think, responsible for the term. He defines it as an entity that lives on the internet, exists autonomously, but also heavily relies on individuals to perform certain tasks that the automaton cannot do itself. So automation at the center, humans at the edges. That's his definition of a DAO. So let me unpack that first, and before we talk about it further. So automation at the center, human at the edges, right? Well, let's look at the automation at the center piece first. So on a platform like Ethereum, you can specify the flow of value in an automated way in code that runs on the blockchain, right? So you can, specify the logic of a transaction. That's what he's talking about when he talks about automation at the center. It's programmatic, automated processes. But then, it's all fine and well to automate things that can be automated. But what about subjective decisions that need to be made? For example, myself and a group of friends want to curate a collection of artwork that we like and pool capital to invest in it, right? So we can use smart contracts to automate the creation of that pool of capital, and that's far more efficient than going to a lawyer and setting up an LLC to do the same. That's the automation at the center part. But then the humans at the edges are me and this group of friends who have subjective human taste on what type of NFTs we want to curate. And so that that's an example of a DAO. That's a group of people getting together, pooling resources in order to go and build something, in this case, a curated collection of NFTs, but leveraging smart contracts to make automation a centerpiece of that group behavior. So that's the definition of a very esoteric term in the Web3 space, DAOs. But I'm really excited about DAOs as a category because they unlock economic coordination that's just not been feasible before, due to the sort of overhead of the legacy financial and legal system. It's very expensive to hire lawyers to set up a company, and it's certainly expensive to both in time and energy to set up a bank account, pool resources that way. But what we're starting to see now is groups do what I just described: set up investment clubs for NFTs, set up groups that are willing to fund new projects that they want to see in the ecosystem, like the S1 club offering on Mirror. And as I sort of touched on it earlier, but this idea of DAOs and investment clubs, I think, can go really far. It can go as far as replacing venture capitalists like Variant in backing new projects that people want to see in the world. And I think it can go as far as the creator economy goes. It can be a whole new way for creators to engage with their fans. So again, I keep coming back to this: rather than subscribe, why not invest? And I think DAOs and investment clubs are going to be a really important part of the way creators monetize going forward. The creators are going to be seeking investment from these groups or pools of capital that form on chain. And a few more examples of this. So Friends with Benefits is a really interesting community that is tokenized. What that means is, in order to access the community, you need to buy their FWB token. And they, describe their mission statement as a cornerstone between the technology and culture communities. So in this gated Discord that stands behind 55 FWB tokens, there's just tons of creators and Web3 folks like myself who are deep on exploring all the intersections of these two worlds. And so a lot of interesting ideas have hatched out of that community, and they're moving from a model where it's just buy the token in order to access the chat, to buy the token, and with the proceeds from that token, we're going to use the community capital to invest in projects that we want to see in the ecosystem. So this is an example of the investment club activity that I expect we'll see a lot more of soon. Flamingo DAO is another one. This is exactly what I described earlier. It's a group of people who've pooled capital to invest in a curated collection of NFTs. And by investing, you get tokens in the Flamingo DAO, which you can use to vote on investment decisions. And I think we're going to see a lot more heavyweight NFT collectors tokenize their collections fractionally in the same way. So lots more Flamingo DAOs.
A quick question there, Jesse. Are there any regulations around which companies can actually accept investment from DAOs, given that there's no restrictions on accreditation to become part of the DAO?
Yes, absolutely. So everything I've talked about in this presentation, you should ask a lawyer about. The whole crypto space is obviously playing in a regulatory gray area, and certainly I think fractional ownership of an NFT collection is in a regulatory gray area. Accepting investment of any kind from random people on the internet is in a regulatory gray area, definitely. But as I sort of alluded to in response to Dave's question, the genie's out of the bottle, and it is already happening at a scale that I think is untenable for regulators to keep up with, and I don't see that slowing down anytime soon. So the advice I give to founders who are building in this space is, obviously talk to a lawyer. I'm not one, so don't take my advice unilaterally, but also, be measured in your risk assessment. You're playing in a gray area, but there are, there's lots of people doing the same, and arguably lots of bad actors doing things far worse. And so some regulatory risk, I think, is par for the course in building in this space.
Makes sense.
Yeah, so I was just going to quickly go over some challenges and opportunities. So challenges in the space today are that there's tons of hurdles to get new people on board, and I think what's remarkable is how quickly NFTs have sort of blown up as a really mainstream phenomena in spite of these onboarding hurdles. So today, to transact in NFTs on a lot of these marketplaces, you need to install a Web3 wallet. Most popular one is MetaMask. In my opinion, it's not a great product. It's really janky. And so that just getting people through the the onboarding hurdle of getting a wallet, figuring out how to get some ETH and pay for the gas costs of transacting on these networks, go from fiat to crypto. These are all, big sort of accessibility problems that are getting solved, but are sort of a bottleneck for wider adoption today. There's also this issue I talked about earlier where, again, if you're building a marketplace to support creators in this category, you need to think pretty carefully about defensibility, because all the assets that creators are minting, whether NFTs or social tokens, they live on the blockchain. They don't live on your platform. And so the question of how marketplaces or platforms building for creators and consumers capture value is a lot more complex than in Web 2. And I think one of the answers there may end up being user ownership as a moat or way to build network effects. And that is to say, if your users have skin in the game, they may be more likely to stick around and use your product and see it succeed. And then, of course, we are in the midst of a hype cycle around a lot of the exciting ideas at the intersection of the creator economy and Web3. And I've been in crypto long enough to see a number of these hype cycles go boom and bust. It happens. It's the natural course of any sort of financial speculation on a new emerging technology. And so the key thing is to make sure that you figure out, product market fit that's going to survive the hype cycle. There will be a correction, and you want to make sure you have a robust community that's with you for the long term and not just there for the flashy headlines and money to be made. And then quickly on opportunities, touched on all this a little bit already, but yeah, more accessibility. We need to figure out ways to build better experiences that are built for this new cohort of users coming into the space. There's technological opportunities to lower transaction costs and make the journey from fiat to crypto less painful. I think lots of opportunities in community ownership and governance, which spoke to earlier as a possible moat. And then composability, I think that's an opportunity for developers. Again, developers can build more with less because you can build on top of the work that others have done in the ecosystem. It's all open. So for folks who are curious, I'd encourage you to poke around on the GitHub for any of the projects that I mentioned. It's all open source and you can remix it without having to ask anyone for permission. Cool. Okay, so that's a wrap on the presentation. Happy to take more questions.
Amazing. By the way, I think this is so fascinating. I think this is the most exciting part of the creator economy. I'm really excited for the demise of VCs. I think it would be a better world in general if platforms were user owned instead of VC owned.
Totally. I mean, that's, honestly, my thesis is really to put myself out of business. Ownership economy thesis, I think the terminal state is that there are no more VC funds.
So this is kind of related to the ownership and kind of IP rights. I was just wondering if we've seen any virtual worlds enforce DRM based on ownership. That is, that only an owner can display a certain piece of art. And if so, like, how do you kind of enforce this in the world moving forward? Where do you see like a bunch of publishers all collectively saying, hey, we'll only allow you to display art if you show that you own it?
Yeah, so it's a good question. I'd say it's definitely possible to do that, and I think there's a lot of there's a lot of design space to explore. Basically features that are unlocked by being the owner of something, I think, is the generalized version of what you're describing. And that definitely already exists. People are building apps for creators where only owners of their NFTs can access features, right? So I think like that's an early example. That said, it's important to note, the NFT is open. Anyone can see the metadata associated with a given NFT, which means it's possible to pirate the content. So I think DRM, it's not I wouldn't make the one-to-one connection between NFTs and DRM. I think they're actually kind of polar opposites, in that the goal of DRM is to constrain the reuse of a given piece of work on the internet. And of course, that's not really been super successful in all the attempts that have been made. And what NFTs do is they allow someone to benefit from the reuse of their work online. So the more times an image, video, or song is shared, the more valuable that ownership of the NFT is, both from a social perspective. It's like, I own the original Mona Lisa that anyone can see on a postcard, on a billboard in the Louvre, and own it, but I own the original one. It confers social value, but also developers will build experiences that confer owners with more utility value as well. But it is just different from traditional notions of DRM.
Hey, Jesse. So I'm wondering, how should curation and content moderation work for decentralized platforms?
It's a really good question. To be honest, I don't know I think there's a number of different ways to approach it. So one thing is, a number of the NFT marketplaces are asking creators to verify their identity by associating their crypto address with a social media account. And they can do that by tweeting, I am this address. And now anyone can take that tweet and associate it with the crypto address and say, okay, this address is that person. And now we have verification, and you should only trust work issued by verified creators. That's sort of like the Web 2, Web 3 connection way to handle this. I think another one, there are more Web 3 native ways to do it. One interesting idea I've heard is that you can use other interactions that the wallet or the crypto address has had on chain to build up a history or reputation for a given address. So, and these ideas are not mutually exclusive, by the way, right? Like, you could imagine, Lee tweets, hey, this is my address. And now everyone who is clued into that can see her verification on a platform like Foundation. But then imagine Lee goes and uses another platform like Zora or Super Rare or something, and she connects with the same address, and she buys a piece of work on Zora, right? Well, now there's two pieces of information that are relevant. One is, this address has a history on chain. It bought something on Zora, and we can surface that activity again without having to ask for permission. There's no risk that data is going to disappear on us. So we can start to build a profile of Lee based on her activity within the Web3 creator economy and interactions that she's had across all the different platforms that her address is engaged with. So I think that may be, over time, the way that we start to build, reputation in this environment. And then, based on that reputation, platform moderators can choose to do stuff, right? Like, can a DAO vote someone off the platform? That could be one thing that's done. Or you could say, anyone who doesn't have XYZ actions in their history can't participate, right?
So how do institutional investors invest in such a world? I mean, obviously it's cool to imagine that, everyone will kind of buy little tokens and a lot of small little things, but a lot of the VC world is sustained by these kind of dinosaurs that have their own way of doing things and change very slowly. Any thoughts on that?
I think they're screwed, to be honest.
I think they can continue investing in the stock market, public equities.
Yeah, that's right. I think, so I'm using hyperbole as a tool here. Look, like, Lee and I are running sort of, venture funds backed by institutional investors. I think that's one way for, big institutions to get exposures through dedicated funds that are focused on the space and tracking it really closely. I do, as we both Lee and I touched on, I do think even VCs that are specialized will come up against competition from, even more specialized fund managers who are, more specialized because they are the users or the fans of these creators, and they have, they're super fans, right? Like, so, why take money from a VC when you can take it directly from your power users, right? And give them an incentive to help grow the platform or service. So all that to say, I think, the general trend, and this is something Lee talks about all the time, much more eloquently than I do, is that we're moving from a world where, from institutions to individuals, essentially. And this is playing out across, many different verticals, including, capital formation, including, creator livelihoods, right? Like, creators are leaving institutions, platforms that gave them an audience in the past to build their own audience directly. And Web3 is just sort of the next logical extension of that, where in addition to, owning your audience, you're actually able to own your work entirely independent of the platform, and potentially even own a piece of the platforms and services that you use every day. And so this is really about a shift in power and a shift in value from institutions to individuals.
Going back to social tokens, I have a question. So we've discussed this idea of investing in creators and how do we give creators access to the capital that they might need to invest in their own content creation careers, but also give fans a part of the upside of their favorite creators' careers. And it feels like social tokens has a very clear application here. And I was looking into the Alex coin and saw that he had this ISA component where he was giving, I think, 15% of his income back to the token holders for 3 years or something like that. I'm curious if you think that is one of the, to your point about like a default interaction model for social tokens, whether that will emerge as like one of the clear use cases for social tokens.
Yeah, it's a good question. So I'm definitely I definitely think it's interesting. Like, the concept of an ISA or income sharing agreement is not new, right? Like, it's been talked about outside of crypto for a long time. I think one of the reasons that it hasn't taken off, aside from, the regulatory issues around it, is just the coordination cost to effectively administering an ISA is pretty high, right? Like, it's a legal agreement, it's an investment in a person, and then someone has to administer the flow of value from that person to their investors. And, how do you accomplish that in a trustworthy way has been, I think, the pitfall of a lot of ISA experiments. What's interesting about social tokens as sort of a reincarnation of the ISA idea is that now creators have on-chain revenue streams, right? So a creator, Lee, like, you sold your NFT for $25,000. That transaction happened on the blockchain. Everyone can see that transaction happened. And it's very easy for someone to write a little script that says, X% of any money this address makes on chain goes to these backers who invested in me. So I do think that could very well be one of the interesting wedges for social tokens that actually, or templates that gets traction near term, because it's all about financial alignment or incentive alignment, and all of it can be automated in a trustless sort of way. So that's a big unlock. I think tokenized access to communities or access to people, I think, is the other thing that's kind of interesting. I think the question is, after access, what happens? And, is it just about getting an hour with the creator? Maybe that's enough, but maybe there's also this idea that once you have access, you're in this in-group of super fans, and you can start to do stuff together. You can pool capital together. You can build a concert that you want to see the creator that you're backing perform at, right? So I think access may be the MVP, and then there's a lot more design space to explore from there.
Yeah, as you mentioned that about the ISA, it feels like there's the thing that needs to happen for that to work for social tokens to represent this ISA is that more of a creator's income needs to be on chain.
Yeah, exactly. That's in a nutshell. But I think that's happening and will continue to happen. So it's interesting. I think also just worth noting on social tokens, this is a little bit of a digression, but social tokens are a pretty polarizing idea because, making a person an investable asset, has all kinds of potentially second order consequences that folks might not realize at the outset. But one off the top is it turns the interaction that creators are having with their audience into a very transactional relationship potentially, and that can be sort of an emotional burden for creators and their fans who are making and losing money together, or and so I just wanted to throw that out there. I feel like that's it's a challenge for social tokens. It's also an opportunity to help people figure out how to reason about this stuff and how to deal with it, because it is happening. But I think it's introducing a lot of psychological load to all the participants that are experimenting with it.
Yeah, absolutely. During the last class, we had discussed the controversy surrounding investing in athletes at the beginnings of their careers when they're very poor and paid close to nothing, and hoping to get a percentage of their larger contracts down the line when they go pro. And that's also a very controversial model, because there's perceptions that the model is very predatory and has this very imbalanced power dynamic between the investors versus the athletes, who are often minorities and English might not be their first language.
Yeah, these problems are all still present, if not amplified, by social tokens, and it's a challenge and it's an opportunity. It's also not all that different from what happens in sort of legacy markets for creator works, right? Like record labels do the same thing to early artists, where they sign them for very little money, and then they hope they blow up, and when they do, they capture most of the value of that, and the artist often sees very little against the advances that they got early on. So that kind of predatory behavior is not new, but I think it can be exacerbated if we don't, if we're not thoughtful about how these products get built out.
Yeah. Okay, maybe we can take one more question. Till, do you want to go?
Yeah, simple question. I mean, on a high level, we just witnessed over the last 2 decades probably a move from ownership to access, which I think makes sense of so many levels. And now we see again a move from access to ownership. And how would you explain the psychology of people again being the owner of something?
Yeah, I mean, yeah, I love that framing of what's happening. I mean, I think, yeah, the phrase I keep repeating is, why subscribe when you can invest? Why rent when you can own, right? And I think we as a society going online decided it was okay to rent access for because it was convenient, but over time I think people woke up to the fact that model empowered the platforms that were enabling creators to distribute work more than it empowered the creators themselves. And those same platforms have incentives that don't align with consumers either, right? Like platforms that get to a certain scale and hit a certain inflection point in their growth curve, they need to extract more and more value from the users of the product or service. So with Facebook, that means throwing more ads on in the newsfeed, or increasing the take rate of any value transacting in a marketplace or so on. So I think over time we've just come to be cognizant of the fact that when you rent, you're giving up power, and the convenience afforded by doing that isn't always worth the trade-off. And so now, with the ability to turn ownership value into packets of information, which that's what tokens are essentially, I think we're lowering the barrier to to this alternate model where you can build platforms that are much better aligned with users because the users own the platforms. And what that means is you can have both the convenience and an economic model that's better aligned over time. And I think we're just in the early stages of waking up to that opportunity. But once people realize it, it will be sort of a 0 to 1 moment in my view, because platforms that aren't offering that kind of alignment to their users won't be competing on the same terms as those who are.
Cool, thanks.
It reminds me of something that Frank Chen used to say to me. Frank Chen was the head of the deal team at A16Z. And whenever I would pitch him like a deal that he didn't like, but I really loved as a consumer and I loved using whatever app or product it was, he would say, you can stay at the hotel, but you don't have to own the hotel. Meaning, why invest when you can just use? kind of the flip of what you're saying now. Like there's some products that you may want access to, but you may not want to invest in, which I think still exists. Like there's content that we like to consume. It's probably trashy content that we don't want to invest in and wouldn't pay for and wouldn't want to own the upside of. So I think that the access model will continue, but I think ownership is additive to that.
Exactly. Yeah, I think that's right. They're not mutually exclusive, but it's just a new model that's possible now, and it opens up, a sort of adjacent territory that was impossible to explore before we could transfer ownership value in the way we transfer bits of information.
Yeah. Okay, last question for real this time, if you have time.
Yeah, sure.
Yeah, I really like this question by Andrea Mazzi. So Andrea's question is, what kind of creators do you see moving towards crypto models first? We've obviously seen a few early successes from creators who have a lot of tech adjacency, but how are you picturing adoption to spread?
Yeah, it's a good question. So right now, given that we're in the midst of this hype cycle, there's a lot of like high profile artists and musicians and all kinds of creators getting into the space. My prediction is, when the market for NFTs inevitably cools a little bit, that interest from established creators will also cool. But that's kind of good news, because I think it seeds way for sort of a new generation of creators to get involved. And if you look at Web 2, it's not the case that YouTube was successful because Seinfeld was on it, right? Like it wasn't the legacy generation of popular creators that made YouTube successful. It was a net new crop of creators who were sort of born and bred in the ecosystem. And so I'm very optimistic about creators who are sort of Web3 natives and sort of building work that makes sense in this new environment. And then those creators continue to grow with the platform itself, as opposed to, the established influencers or artists of today sort of being the ones to pioneer it.
Awesome. Well, thank you so much, Jesse, for doing this. This was awesome. It was really, really amazing. I think we all learned so much. Our minds have been expanded. If you're building something in this space, you should definitely talk to Jesse as an investor. Really, there's no one better to raise money from, and maybe you guys can cut me in too. And yeah.
Thank you. Feel free to reach out if anyone is building. My DMs are open, and I love talking about this stuff more than anything in the world. So yeah, feel free to hit me up with any questions or ideas that you have.